we are taking up onto paper 8A. Financial management. 8A financial management. It runs to 13 sheets of PDF. This is mostly on to capital budgeting. Now let us just start with a discussion on to these questions. Question number 1, TIP Limited is considering two mutually exclusive projects M and N. You have been given below the net cash flow probability distribution of each project. Project M, 62,500, 73,000, 87,500. Probabilities are 0.3, 0.3, and 0.4. And for project N, 162,500, 137,500, 112,500, 0.2, 0.3, 0.5. Required. The expected cash flow for each project, variance of each project, standard deviation of each project, coefficient of each project. Identify which project would you recommend, give reasons. So we are expected to select one out of this two mutually exclusive projects. If I select M, I got to reject N. If I select N, I got to reject M. So ultimate one between the two, I got to select one. The expected cash flow of each project. Say, but what is missing is the term is missing. Cash outflow is missing. It becomes a little tight to operate that. So, but what we can do is that we can multiply 62,500 with 0.75,000 with 0.3, 87,500 with 0.4. Now let us just take the calculator and operate on this. 62,500 into 0.3, 75,000 into 0.3, 87,500 into 0.4. All that comes to an expected cash flow is 76,250. 76,250 is the answer for the first question. That is project M. 76,250. Based on this, we can't take any decision. Now let us just find out for N. 162,500 multiplied by 0.2. 137,500 into 0.3. 112,500 into 0.5. 1,30,000 is the answer for the second question. Variance of each project. How do we find out variance? See, unless we know the mean, it becomes very tight for us to find out the variance. But we can just do that. Standard deviation of the project also you can easily try. Coefficient of each project you can try. So now I would like to take up 76,250 and 1,30,000 in the second case. Variance of the project is worked out. Standard deviation of the project is worked out. Coefficient of the project is worked out. So based on coefficient, we are expected to arrive at the final answer. So I would like to solve this problem with the help of Excel. Excel is a better tool where I can demonstrate the entire working rather than going to do a PPT. See, now just watch out as how we will be doing it. Project M. Cash flows are $62,500. Sorry, 62,500, 75,000, 87,500. Let's just check up. Yes. Yes. With probability 0.3, 0.3, then 0.4. Expected cash flow. This cash flow multiplied by probability. 76,250. So same thing, I would like to do it for project N, where the cash flows are 162,500, 137,500, 112,500. 162,500, 137,500, 112,500. Let me confirm the number. With 0.2, 0.3, then 0.5. So, first part of the question, expected cash flow. The expected cash flow for two projects are 76,250 and 1,30,000. Right. What is the second question? Variance of each project. How do we find out variance? Variance of each project. Just copy paste. Now, variance I will take up now. How do we calculate variance? All of you just check out. Equal to probability multiplied by 62,500 minus 76,250 to the power 2. So variance being 10 crore 78 lakhs 12,500. So variance of project M. Variance of project M is like this way. Now let us just take up variance of project N. Which is nothing but how this variance is to be computed. This probability into 162,500 minus 1,30,000 to the power 2. $38 crores 12 lakhs 50,000. So where is that they have mentioned these numbers? Just see 10 crores 78 lakhs 12,500. And in this case. Now let us just know about us how this variance we have computed. So which is 0.3 multiplied by 62,500 minus 76,250 to the power 2. Next one, 0.3 into 75,000 minus 76,250 to the power 2. 0.4 into 87,500 minus 76,250 to the power. So that is the way we are arriving at the variances. So likewise in other cases also. So number one, we have got the first answer for the first part of the question, expected variance. Standard deviation is a very simple process only. Standard deviation is equal to square root function SQRT within brackets. So this is the number that I just get. This is the standard deviation. 10,383.28 and 19,525.624. This is what we have just got it as the answer, right? Then what is the fourth question? Coefficient of variation. So we all know coefficient of variation is something but standard deviation divided by mean. Coefficient of variation is equal to standard deviation divided by means. For project M, it is standard deviation 10,383.28 divided by mean of 76,250. This divided by this in terms of percentage. Lesser the percentage, lesser will be the deviation. For project N, $19,525.62 divided by 1,30,000. So 15.02. So the one which has got higher percentage is riskier. The one which has got lesser percentage is less riskier. So the question, which project you would recommend? M is what they would have taken. So 13.62. Coefficient of variation of M is 13.62, whereas in the case of N, which is 15.02. So the risk per rupee of net cash flow is less in the case of M. Therefore, M is better than N. Is that clear? So, rank 1 and 2. So, why? Because risk level is lesser. Risk level is higher. So strategy, accept. Question number 2. This is about dividend policy. One more response also. Yes, Janie also is telling us. Thank you. See, in case of any doubt, please just don't hesitate. Please. Akash has 10 lakh equity shares outstanding at the start of the accounting year 2021. The existing market price is 150, expected dividend is 8. The rate of capitalization appropriate to the risk class to which the company belongs is 10%. Calculate market price per share. Then expected dividend or A declared, not declared based on approach. Then calculate the number of shares to be issued by the company at the end of the accounting year on the assumption that net income is 3 crores, investment budget is 6 crores when dividend is declared and when dividend is not declared. Prove that the market value of the share at the end of the accounting year will remain unchanged irrespective whether the dividends are declared or dividends are not declared. Say, how do we approach? this problem. And especially they've indicated the model that we're going to follow. This is question number 2. Under Modigliani and Miller approach, P1 is equal to P0 into 1 plus KE minus D1. This is the formula. So people might ask this question, sir, how do I remember the formula? There is a shortcut way through which you can remember this. What is a shortcut way through which you can remember? Very simple, general understanding only. Say if I were to be the holder of shares, my rate of return on investment is equal to income divided by investment. 2 minutes only. What is my income? Income is going to be my dividend plus the appreciation in the price of the share. This is dividend, this is appreciation. Divided by initial investment, that is P0. So you can say dividend as D1 divided by P0 plus P1 divided by P0 minus P0 divided by P0. And this is going to be my rate of return, and that is going to be cost of capital for the company as a whole. Cost of capital for equity shareholders as a whole. So now KE is equal to D1 plus P1 divided by P0 minus 1. So 1 plus KE equal to D1 plus P1 divided by P0. Now P0 into 1 plus KE equal to D1 plus P1. So P1 is equal to P0 into 1 plus KE minus D1. So a simple formula only through Modigliani and Miller we could just get. No big deal. If you know the origin, no, as how the formula is derived. Even if you forget the formula, you can derive the formula. That is the reason 2 minutes I took to communicate as how cost of equity is arrived at in Modigliani and Miller approach. Now let's read the question. Calculate the market price per share when expected dividends are declared. So existing market price is 150. The question is that calculate market price. They have not mentioned clearly which timing of market price. So it should be P1. That is what we have to understand. So sometimes we should infer that question is for P1. When dividend is declared, when not declared. When it is declared, P1 is equal to P0. P0 is 150 into 1 plus 0.10 minus the dividend is 8. So it is 150 into 1.1 minus 8. It is 157. When it is not declared, 150 into 1 plus 0.10 minus nil. P1 is equal to 165. First part of the question over. Second one, calculate the number of shares to be issued by the company at the end of the accounting year. This is what they have mentioned here, end of the accounting year, on the assumption that net income for the year is 3 crores and investment is requiring, investment budget is 6 crores. So now let us just see the number of shares that they have as 10 lakh shares. So please understand, for the second part of the question, investment is 10 crores. This can be split into two when dividend is declared. When dividend is declared when dividend is not declared. When dividend is declared and when dividend is not declared, so retained earnings in this case would be net income is 3 crores, PAT minus dividend. PAT is 3 crores. Here it is 6 crores. Minus the dividend, 10 lakh shares into 8 per share as the dividend. So therefore it is 80 lakhs or 0.83 crores minus 0.8 crores. This is equal to 2.2. That means out of 6 crores, 2.2 crores retained earnings itself will be there. So further issue, fresh issue will be 6 crore minus 2.2 crores. So which is going to be 3.8 crores. When dividend is not declared, retaining earnings going to be 3 crores. Because PAT minus dividend, PAT is 3 crores minus dividend is nil. Therefore, it is 3 crores. So fresh issue will be for 3 crores. How come? 6 crores minus 3 crores. Now, the question what they asked is that calculate the number of shares to be issued is what they asked. So, number of equity shares to be issued will be 3.8 crores divided by what is the price per share? The price per share is 157. Here it is 3 crores divided by 165. So number of things 3.8 into 100 into 1 lakh divided by 157. So it gives you 2,42,038 shares, or you can round it off to 39. Next number 3 crores divided by 165. So here you get 1,81,819 shares. So that many shares you are expected to issue. So here it is rounded off. In terms of lakhs, they have rounded off. So I'm just going exact number. So 3.8 crores and 3 crores. That is what they mentioned in the form of a table. Are you understanding? Then what is the next question that they asked? Prove that the market value of the shares at the end of the accounting year will remain unchanged, irrespective of whether dividend is declared or not declared. No big deal. Third part of the question, when dividend is declared, when dividend is not declared. So, old number of shares 10 lakhs. New number of shares 2 lakh. I will put the full number. 2,42,039, 1,81,819. 12 lakhs 42,039. 11 lakhs 81,819. Okay. The market price per share in this particular case being 157, in this case 165. So what should be the market value? 12,42,039 multiplied by 157. So it comes to 1,950 lakhs. 11,81,819 into 165. So 1950 lakhs approximately. So the dividend is not influencing the price of the share. There is the wealth of the capital in either case. And this is the way we have proved. How they have proved? 1950. Hence it is proved that market value of the shares remain unchanged, irrespective whether dividend is declared or not. That is what we have just worked. Now the third part of the question is going to take some amount of time. So that will take more than 45 minutes to complete. Now let's just go through that. So with 12 minutes to go, how best we can use that 12 minutes? Let us see. X Limited is considering installation of new machine with the following details: initial investment, annual units in sales, selling price, variable cost, annual fixed cost, depreciation, discount rate, tax rate. Consider the life of the project as 4 years with no salvage value. Calculate the expected NP of the project. Compute the impact of the project's NPV if change in variable is under, and also compute which variable is having maximum impact on NPV. So under that variable, unit sold is 85 crores, selling price 39, variable cost 22, annual fixed cost 574, and 12% PV factor is what they have given. So now let us just take up the basic computation in this fashion. It is selling price is 40. Contribution 20. Number of units 100 crores. So the first one is contribution per unit. Contribution is 20 into 100, 2000 crores. Fixed cost is 500 crores. Profit before depreciation and taxation. 200. Profit before taxation. Tax rate 30%. Tax amount profit after taxation 300 minus 90. Cash inflow, which is equal to PAT plus depreciation. VAT plus depreciation. Oh, depreciation not taken. Let me just check out. Depreciation 200. Now let me just put it this way. Depreciation. So profit before thing is equal to contribution minus fixed cost minus depreciation. Okay, so that is not a matter at all. So this we have got it, and it will have 4 years of life. So annuity factor so year number 1, 2, 3, 4. Present value factor at the rate of 12% from 1 divided by 1 plus PV of cash inflow. Discounted cash outflow. Discounted cash outflow is 1400. Let us just take the matter for the purpose of discussion. So this could even be worked out 110 into 3.03. So net present value represents 1972.18. 1972.18. We have just got it like this. Okay. We have answered to the first part of the question. Calculate the expected NPV. You have just got it. We have 5 more minutes. Please understand. Compute the impact on project's NPV if change in variable is under. And also compute which variable has got maximum impact on NPV. So instead of 100 crores, make it as 85 crores. What sort of impact it is making? So one at a time you have got to make. Okay. Then selling price 39.22 and annual fixed cost 575. Just watch us how our Excel is going to do magic. This is original figures. Okay. Now I will copy it. Original I will copy. Original I am copying it. Okay. See now how we are changing it. Let us just see. This I would like to change it based on units. So I will change it to units. What is the unit they want? 85 crores. So here instead of that, I will put it as 85. Okay. Only one change, the entire thing underwent change. Next. Next one, where I want to have the selling price as 39. Selling price 39. I make this as 39. Change happened. Variable cost. Variable cost 22. 22. The next. Fixed cost 575. Okay. Now, what is the conclusion you would like to draw? We have 3 more minutes. Just watch. So, when it were to be units, original NPV was 1972.18. 1972.18. Okay. What is the change? Change is this much in percentage terms. In percentage terms. 637.98 divided by 1972. So it impacted how much? 32.35%. So I would like to take up this units and I would like to put the selling prices. Variable cost, fixed cost. Okay. Now, which one is more sensitive? The percentage change is more sensitive in the case of units, and therefore more sensitive is units. What was the question that they asked? Which variable has got a maximum impact on NPV? So, what is it they have mentioned? Just see 32.35. 32.35. Next one, 10.78. 10.78. 21.57. 21.57. 8.09. 8.09. So, selling price, sorry, number of units. Units happen to be the most sensitive factor amongst the 4. Question number 4, the following information is supplied to you applying Walter's model. Total earnings 2 lakhs, total number of equity shares 20,000, dividend paid 1,50,000, price earning ratio is 12.5. Analyze whether the company is following an optimal dividend policy. Compute P ratio at which the dividend policy will have no effect on the value of the shares. Will your decision change if P ratio is 8 instead of 12.5? Analyze. Now, let's know about Walter's model. Question number 4. Walter's model of finding out price P0 is equal to D plus R divided by K into E minus D, the whole divided by K. This is the formula that you have for Walter's model. Okay. So in this problem, earnings per share is E stands for earnings per share, which is equal to 2 lakhs divided by 20,000, which is 10. D, dividend per share is equal to 1,50,000 divided by 20,000 is 7.50. And P ratio, they have mentioned it as 12.5. What is the relevance for P ratio is what people might just think. So P ratio is equal to 12.5. We all know KE is equal to, there is one more formula, 1 divided by P ratio. 1 divided by 12.5. So 1 divided by 12.5. So that means it is 8%. K is equal to 8. Okay, we have just got it. Analyze whether the company follows optimal dividend policy. Firstly, we should know what is optimum policy to say that whether it is following optimum policy. So, and we are expected to know about what is the return on equity, or also we are expected to know. So, price earning ratio we have just got, dividend paid we have got, or return on equity we have to get. How do we arrive at return on equity? Return on investments, you can say, not return on equity, but return on investments. So we can put everything appropriate and get the final answer. So now I will give you the findings of Walter's model. If R is greater than KE, payout ratio should be the least, say 0%. If R is less than K, payout ratio should be the highest, say 100%. If R is equal to K, any payout ratio should give same effect. Correct. I'll tell you how. Imagine that money with the company is giving you 10% return. Money with the company, money with the shareholder is fetching 8% return. Let me repeat. Money with the company gives you 10% return. Money with the shareholder is only 8% worth. Whether it is good to have more money with the company or good to have more money with the shareholders. So money with the company is fetching greater rate of return than money with the shareholders. So therefore, greater amount of money to be left would mean it should be the least amount of money to be kept at equity shareholder side. That is why we say that payout ratio should be the least or 0%. If money with the company is less and money with the shareholder is getting better returns, would mean pay all your profit in the form of dividend. If both R and K are same, whatever may be the payout ratio, which will have the same effect. This is what we have as a taking for Walter's model. Now analyze whether the company is following. Let us just see as what exactly is the thing that we have. EPS of the firm is 10. P ratio given is 12.5 though. Therefore, the cost of capital is 8%. So now we understand that R is indirectly mentioned as 10%. That is the reason as why I have just given that particular example. So when you have the number of shares of rupees 100 each, when 2 lakhs as the capital with 20,000, the return on equity is 10%. Or in this case is earnings divided by equity. 2 lakhs divided by 20,000 into 100, which gives you 10%. Now you can understand, analyze whether the company is following an optimal dividend policy. What is the statement that we have made? If R is greater than payout ratio should be the least. Here payout ratio is 75%. How do you know the payout ratio is 75%? Payout is 1,50,000 divided by 2 lakhs is equal to 75%. So we understand that it is 75%. Now 75% payout ratio is not good. So we understand. So just see, theoretically the market price of the share can be increased by opting for zero payout. What is that hybrid return? Should be the least, zero payout. So now with this, what is the market price per share? Present market price per share is equal to dividend is 7 rupees and 50 paisa plus 10% divided by 8% into 10 minus 7.50, the whole divided by 8%. 0.1 divided by 0.08 into 2.5 plus 7.5, the whole divided by 0.08. That should give you the number market price per share as 132.81, right? This is at present. At ideal condition, of zero payout ratio, it would have been 0 plus 10% divided by 8% into 10 minus 0 the whole divided by 8%. Okay, 0.1 divided by 0.08 into 10, the whole divided by 0.08. That gives you a number of 156.25. So getting 156.25 is better or getting 132.81 is better? So getting 156.25 is better. Here, if you say the wealth creation, wealth is in the form of dividend and price. If you have 75% payout, I mean you have 0% payout. So dividend is 7 rupees and 50 paisa. Here it is 0, 132.81, and it is 156.25. Ignoring time value of money. If you put time value of money, this value will even come down. So ignoring time value of money is only for advantage. So it is 140.31. Here it is 156.25. By taking up time value of money, this figure will be much lower. Even I am just taking a little higher figure. Comparing between the two, wealth is more by following zero payout. This is what we have to answer for the first part of the question. Do you agree with me? Second one, compute the P ratio at which the dividend policy will have no effect on the value per share. Already we have answered to that question in an indirect form. What is that? If R is equal to K, any payout ratio would give the same effect. There will neither be increase nor decrease, any payout ratio. So therefore, in this case, compute P ratio at which the dividend. So when it is P ratio is 12.5, it is 8%. So your return on equity is 10%. So when your P ratio is 10 times, 1 divided by 10 is also 10%. So at that particular level, the value per share will be constant. So we will answer to that question. If P ratio is 10 times, cost of equity will be 10%. How come? 1 divided by 10. This 10 only will see that here. And the company's R is also 10%. So any payout ratio will give no effect on selling price, no effect on price. So therefore, answer for this particular question is 10%. Compute the PE ratio. Will your decision change if PE ratio is 8 instead of 12.5%? Naturally, it will change. If PE ratio is 8, no. 1 divided by 8 is 12.5%. There, I would say better go for 100% payout ratio. Yes. P ratio 10 times. If P ratio is 8, third part of the question. If P ratio is 8 times, KE will be 12.5%. That is 1 divided by 8. So therefore, R will be 10%. KE will be 12.5%. So R is lesser than K. So for this, payout ratio should be the highest. That is 100%. Now let us just check. This is the third part of the question. Let us just check. Dividend paid. No dividend paid. What is the price? When dividend is paid, all the dividend. So that is 2 lakhs divided by 20,000. This is equal to 10. 10 plus 10% divided by 12.5% into 10 minus 10. The whole divided by 12.5%. When no dividend is declared, nil plus 10% divided by 12.5% into 10 minus nil, the whole divided by 12.5%. Is equal to rupees 80. When no dividend is declared, 10 into 0.1 divided by 0.125, the whole divided by 0.125. That gives you rupees 64. Which one is better? Declaring dividend is better or declaring no dividend is better? So inference that we draw. Inference drawn. A. If R is greater than K, payout ratio should be nil. If R is less than K, payout ratio should be 100%. If R is equal to K, anything is good. This is the inference that we draw.